Yeah, okay. No, but if there's some questions, please don't hesitate to ask. But what I'm trying to do is to sort of give you a framework of how decisions are made in an insurance company when it comes to investments. Yeah, because I see from this crowd, people who are into capital markets. So that is the keen interest. And I can see from Mr. Kannan's presentation. So there'll be some repeat to what Kannan said, but I'll get to a little more granular level than that. Because in an insurance company, we have the insurance committee, right? And we meet periodically. There are economists who are very close to what Mr. Kannan's presentation is, right? And I'll give you that insight as well. But that is the macroeconomic aspect. But that information is then fed to the investment managers who are making decisions to invest. So that all what you heard is an input to actual decision making for investments.
So but you have investment committee also?
Yeah, of course. You have the governance structure, right? So you have to. So I sit in that investment committee, but more as a listener, just like I was listening to Mr. Like that presentation. But I get that macroeconomic understanding. But change the slide. Yeah, I'll do that now. Yeah. So I'm just giving you the background, but so that I understand what is your interest from this crowd, whether you're more interested on the capital market side of things or more on the insurance aspect, because otherwise I can keep talking. Okay, I'll tell you that, but that's not my. I can tell you all disclaimer is I'm not the super expert there, but I designed the products with the asset managers so that because I'm an accountant and I have worked for the regulation like RDA, like it's called the NAIC, so I know the regulatory framework under which the insurance companies operate, because and its bottom line is for every investment, for every asset that an insurance company has on the balance sheet, there's a capital charge. You know what's a capital charge? Yeah. That means it's a formula. It's a risk-based capital, right? Just like in banking, same thing by insurance. So it is very important that. Just turn and say. I'm not interested there, yeah. There's a lot of content. Okay, so. Okay, yeah. So I'll just talk about Okay. So I can just give you a little bit on the economic drivers in the US, and I hear that every week because every week the office keeps sending the slides US mein and all that, so that investment managers are aware of it, and I'm also aware of that. So it's a more hands-on information that you will get from me here. Again, a lot of that is public information. I can't give you my company secrets in that sense. But the second thing is the geopolitical risks, because that eventually will define, because the issue that right now every US insurance company is facing is recession. Is it a soft landing? How tough will that be? Because everything is booming right now from a stock market perspective, but the reality sometimes is a little different than the stock market, and that has to be understood from two angles. One is for the bond investments, because don't forget, the equity is not the only market; it's a bond market, right? And insurance is a big bond market, and the other than bond market, which we'll talk about, and which is actually my specialization. And then we'll talk about the impact for the insurance companies. And then what I would like you to understand from you guys is ki India mein, how is the scene for insurance companies, because it's still a developing economy, and there is a need for insurance, because insurance is not only to minimize the risk, but it's also for economic growth. So there is a link between having a mature insurance market for the country's economic growth. For example, if you say CAT risk, which is catastrophic risk, in US, I was giving that example, like you have the whole Florida can be underwater, but hey, you still have big real estate there, right? But there's somebody who's taking away the risk of floods, hurricanes in Florida. Why does that? Why is it not happening in India? Like in whole of Kerala or Tamil Nadu, Telangana region, which is cyclone, Japan, if you see earthquake risk is taken out somewhere else. So there's something called reinsurance, where the risk is basically reinsured to some other foreign reinsurer. India doesn't have that maturity in the reinsurance market. So I'm looking for those areas where I want people to think, how can insurance be used as a tool? Not just for just taking a medical risk or insurance or auto insurance, but as a tool to promote economic growth. So we'll talk about that.
Here also, Indian insurance companies take reinsurance.
No, but reinsurance whom? From where? So that market, but okay, so in some areas, yes, but they're in the cat risk, which is catastrophic risk. Like, yes, I was giving the Florida example, cyclone and all that. That thing is I would say there's more potential, because once that risk is taken away, then Ambani or Adani will start investing in those areas. Even like Kashmir, for example, right? There's political risk, and there's a lot of other risks. So when I was working for a company that was in political risk area, that you can take political risk away. Just an example. So anyway, let me start from here.
GIC here, so is it open?
Yeah.
Reinsurance.
Yeah.
Zurich Re, Lloyd's, Munich Re,
Yeah. Right. Yeah. Okay. So that's a good input. So the first. So the first topic is economic growth and recession. And I'm just giving from 1947 a chart of
Thank you, sir.
कब US में recession हुआ है, and you can see a certain trend in when recession happens. So it's something. It's not about if recession is going to happen. It's about when it's going to happen, basically, right? That's what I'm trying to say in this slide. And you can see, because Mr. Kannan also had a survey which was pretty similar to this one, where this information is coming actually from the
America Merrill Lynch, no?
yeah. So there's an organization which
It's a return, Bank of
yeah.
Global Fund Manager.
Yeah, but let me just
Person saying recession management.
yeah.
So what does -80 mean here?
So that is because this is a recession, but at some point in time, it was not about recession. It was they were not expecting recession, but a boom.
Technically, if you have to define recession, if 2 quarters,
Yeah,
if the
that's
economic growth is minus,
well,
then only it is a recession.
yeah,
If
but
it is even positive 0.1%, it is not recession.
yeah. So so there's the economic growth and there's also unemployment. That aspect of unemployment is also generally we track that more easily in our committee. So you will see that in the past, recessions lasted 6 years, but more lately it is recession lasted 10 months, but there was space of 6 years. More recently, it's almost 10 years that you have recessions. So if the question is, if your last recession was, yeah, so if it is 20 in 1920, there was a recession in 2020, so maybe 26 around that time, there could be a recession, or it could be a little bit earlier also, depending on how things are. Your question, Naresh? Yeah, so that's a sort of timeline. No, let's say just again.
Not before that.
Yeah, so there's a general. Your definition is correct, but generally, there's a whole strong correlation between unemployment and recession, right? So I'll give you some data on that, which we track more. I would say as a company, and you will see that there has to be a shock event that generally you see when recessions have happened in the past. So like a housing bubble ho gaya, tech bubble ho gaya. This later on was more an exception because of COVID, but that was more like an immediate effect. Otherwise, you will see that there is a shock that happens because of these events, and then followed by recession, right?
But in 2024, job creation worldwide, they expect incremental jobs compared to this year will be 19% higher.
Yeah.
That is the forecast.
Yeah.
In spite of a year. Oh.
Yeah. So what we do as a asset manager, we also track this very closely. The home builders index, inverse of that, and unemployment as an indicator, because when this is a reverse of the home builders index. That means kitne buildings ban rahe hain in the whole US, right? So when it's high, means there is when the index is inverse, right? So when it's at the high points, that means that there is compression of that means that people are not buying houses, they're not building things. And so you see over here that within a certain lag, there's an economic lag, and then you have unemployment. So this is the black is the home builders index inverse, and then you have the unemployment which follows. So you can see that follows. So if you push the graph, then you can almost coincide because there's a lag, right, between.
How can it be that when the houses are being bought by or bought traded?
See when.
What is the relation?
Okay, so let's say in simple language. So when there is when there's contraction, there's less homes being built, yeah. That means people are buying also less stuff for their houses. Yeah. So which is an indicator, because that and home building and buying stuff for the houses is a big indicator for unemployment coming in the future. Yeah. Less homes being built, and therefore, as a result, less things being bought for the homes, refrigerator, is an indicator of unemployment to come in the future.
In the current scenario, in like India, a lot of houses are being activities are being going on. A lot of inventory is in pipeline. Old inventory has been sold completely.
Yeah.
And no inventory is in pipeline.
Yeah.
How to read this?
So you if then inventing the pipe, you have to just look at I don't know the home builders index here. Is there has to be index. Follow the index, follow the graph. Yeah, there has to be index, and then follow unemployment with that. And then you will see that there is a connection, a correlation. Yeah.
But I think this year,
How to impact on the housing prices now, mortgage.
I'll come to that. But I'm just giving you we follow that pretty closely. I'm just giving my day-to-day what information we get, and we use this as our sort of basis.
Yeah, that's what we are trying to understand.
Yeah. So that's why
it is also related to interest rates in the
so that
economy.
will come back. So this is just a lead indicator to give you a sense of how we predict a lot of things in the future, and then eventually making investment decisions of what to invest in. Yeah, so we have to follow. This is the data that even the senior board members and all are given, right? And then next step is, okay, asset managers have to come, and we have asset managers for each class, for mortgages, for securities, structured products, so things like that. So so what we are seeing is that once you move the thing, then right now, if you see here,
The housing interest
is up at this moment, right? Because interest rates actually, I will talk about that, but interest rates have suddenly gone up to say 8%, 7%, because the Fed has so there has been a contraction. Yeah. Unfortunately, you have expected the expectation, as I said, is unemployment should go up. More people should be unemployed, but that has not happened yet.
Yeah.
So now that's what we have. Yeah. Now you think about, because if unemployment happens, then recession, because we said definition of recession is the unemployment part. So then there's a likelihood of recession. So your home prices can define whether recession, you can get a sense of whether recession will happen or not happen, right? So that's what I'm trying to.
So this is inversely related.
Correct. The home price is inversely. Correct. Yeah.
Unemployment.
Correct. Yeah. Inverse of the home price is.
Understood.
Yeah. So that graph is a very interesting graph, which we follow very closely. So now. Yeah, so I was telling you, you came late, so you missed the class. Teachers se pucha hai ki.
Sure, sir. For the benefit of everybody.
Yeah.
Naresh, I'll introduce it. For self-introduction.
Arey bolo yaar.
I'm Jayesh Gandhi. I'm from SRBC.
Partner on senior.
Yeah.
Okay, so yeah, so that is the correlation. So now you whole idea is, can you predict anything with that information? So the theory says now there should be unemployment. So we all know that. But then the next part of my presentation will be what measures are being taken to control that. And that will define ki ab recession 2024 mein aayega ki 2026 mein aayega, there's only so much room to play up because you're going against the forces. There are some forces happening, but you're going against the forces, and there's only so many measures you can do. Interest rate, yeah, bank credit, yeah, bank tightening. So you got a few measures that you can take, and which is what the Fed is doing. So what I'm trying to say is that you have to watch right now the whole economy, because we're in a very settled position, is very dependent on what the Fed says, at least for the US perspective. And then it has a repercussion effect on the rest of the world in dollar terms, because it affects the dollar prices and everything else. So I would say what Fed says, actually we're at the mercy of Fed in a lot of respects, because because I'm saying US is already a high debt country, So it's a very sensitive, people don't realize that the big thing that you see in the US is all dependent on very small things can impact, because, dollars as a reserve currency. So we'll talk about that in the geopolitical area, but I think as long as it's going good, it's good. Yeah, I would say that. So it has to be measured. It has to be done very carefully.
I think US debt is $28 trillion.
31, yeah. 30,
31.
yeah. So anyway, so the one option which was here is technically unemployment should go up, but I'll talk about the measures. Whether the question is for us right now is whether that home price index will come down or not. And that is the $1 million question right now, for us.
If the interest rate comes down, no?
Yeah, and we'll talk about-
Index will go up. Because now interest rates will come down,
Yeah.
then people can afford more homes. So then home price index will go up.
Right, exactly.
What about unemployment? Unemployment also will come down.
Yeah, then inflation will not be.
Yeah, so we'll talk about inflation, the connection between. So it's a like a triangle, right? Inflation, unemployment, bank credit and lending. So there's some tools.
But we have to see the weight. And
But there's one more factor which is very interesting, which I want to talk about, which we follow very closely. Okay. Oh, somebody's waiting. Yeah. So while he's doing this, so yeah, these are factors which are monitored by our economic department, yeah, and fed to us who are in the investment team, because at the end of the day we have to allocate assets. Yeah. So in the asset allocation process, and at the end of the day, it's an art. It's not just a science; it's an art. How you allocate assets, but you have to do it on some basis, and we use this as our sort of basis.
See, this Canada pension funds.
Yeah.
They invested $80 billion in Indian
Yeah.
market.
Yeah.
So what is the plan for US pension funds to invest in Indian market?
So the
Do
way,
you have any discussion?
yeah,
during the meeting
so
on
yeah,
India?
so people is not about Indian, it's an emerging market. So first, don't forget, it comes as emerging market, that classification.
Yeah.
How much are you willing to, so Brazil, India will all come in one bucket.
Yeah.
Yeah. But yes, you can see that recent trends have been that India is becoming very important for the US. And that has to grow because of political reasons also. The US is not India's brother or sister. At the end of the day, they are looking for their own benefit. But what was in the past, because they needed, in the past it was Cold War, they were funding Pakistan for a reason, but now it's China. So now they have to rely on India geographically. Yeah, so we all know that.
China has invested more than $1.5 billion in US market.
So
That's why US wants to keep China happy.
in a way, yes, you are right. But yeah, but it is so the whole thing about decoupling. So decoupling technologically and financially, both, because the semiconductor is another issue, because that's also leading the world. It's also a leading thing for the US-China relationship, the Taiwan issue. So yes, so one thing I want to also talk about, which a lot of people don't know, whether I want to understand from you people, how much is that followed? Because if you see right now, the corporate cash in the US, the amount of cash that corporate is at significant high level, reached almost 250 or 70 billion last year. And why that happened? Because of all the money that was pumped for COVID. Yeah, it was just one day you get all the money, and the companies are just keeping that cash. And And very interesting aspect is the relationship between that corporate cash that is companies are having and the ability to fire people. Because talent is a big problem also in the US at certain not just talent, but overall. And maybe it's a little different from the US because there's something called the labor participating rate. How much of the labor in today is productively contributing to the economy? Yeah. You can see that at some point it was very high, but it suddenly went to very low amount. Reason, you know why? Because when government gave free money, because see, US has this ability to print money, which no other country has at that level because it's a reserve currency. So because dollar is a reserve currency, US is complacent about printing. Because for anything it gives a steroid. It doesn't think too much. In one day, you can make a decision to print money. So people, when you print money, then people just don't work. They've got the money, they've left the labor force. Yeah, they've left the labor force and they want to come back. So that's a problem. So the issue for the corporate America, for the cash, is to keep the employees or to fire them. Because if you fire them, so that has to do with unemployment, right? Because if you fire them, then there's more unemployment. Yeah, and so that is another issue on the economy. But if you keep them, then you are draining your cash resources. But that companies have to balance that in a certain. We're not only looking at Google and we're looking at the overall industry as all the different economies, especially the real estate market and building market and all those things. So during COVID, you can see suddenly the labor participation had gone low. Yeah, but people are coming back at the end, if you see. In the marketplace, but still very low. So if it's difficult for companies to find people, then they have to decide how much of their own cash to drain. But at some point, they'll give up also, right? And there'll be a drain, and then the riskiness of the recession happening is higher. So you have to get the link between a couple of things. When you talk about recession, hoga ki nahi hoga, there is house building to be taken care of, corporate cash to be taken care of. The next thing to be taken care of is the mortgage rate, because the housing industry is linked to the mortgage rate at the end of the day, which is also then eventually linked to inflation, because with all the pumping of money, inflation had risen, right? So right now the Fed rate, so the mortgage rate is linked to the Fed rate, right? Your basic baseline rate, Fed rate. So you can see that correlation between the Fed rate and the mortgage rate. Yeah. So you said in your presentation 5 point something. 5. Yeah. So that's what is being reflected here as well. Yeah. So we are, at least I'm giving the right information. So that's good. So here at the same thing, because, but something very interesting has happened is when the inflation had risen to almost 9% in the US, which is never, it was very uncommon.
Now it is 3.
Yeah, people were panicking. Everybody's saying recession. That was just a few months ago. Yeah, but now the inflation has significantly come down and the Fed rate is higher, which makes Fed easier to decrease their Fed rate, which means once the Fed rate comes down, then the housing market, because mortgages will come down and the housing market can improve, more people will get jobs, they'll buy things for their homes, and that's how the correct. So that's a circle that at least we live in from economic variables, getting to understand recession hoga ki nahi hoga, whether it's hard recession or slow, soft recession. So we follow that pretty closely. Yeah, and the other item, but there's another villain in the whole story, right? Which is how much credit are bank giving. So if you see back in 1995, okay, so you can see that this is also a reverse bank lending analysis, because when the lending is tight, yeah, when the lending is tight, the blue one, yeah, there's unemployment. So just like you saw how the relationship was between
So tell me then NPS are on the rise.
Huh?
It leads to unemployment. How do people, service the mortgage?
yeah, so then there's more that's a vicious circle, right? People are unemployed, they're not servicing the mortgage.
He's asking the current situation. So, Ani, what is the NPA rate?
Huh?
NPA rate, gross NPA
Your mortgage? Huh?
on mortgage.
I know mortgage right now is
Less than a percent.
Huh?
Less than 1 year is less than. Should be, I don't know.
no, but because I'm maybe not understanding the term. Is it the
Non-performing.
oh, the non-performing NPR, the non-performing yeah NPR. Okay, so the non-performing there could be a number for that. It's a good question, but yeah, that's disclosed in the bank financial statements. They have a 90 days overdue and non-performing. Yeah. So
But overall, I say. Think to the industry specific.
industry perspective, when the interest rates are high, there has been a lot of yeah. So there is the I just know that there's a high level of non-performance in the marketplace. I can't give you the number right now because we
would like to acknowledge the chairman of a very well-known startup and experience with Hindustan Lever and many companies has joined on Zoom, especially to see the presentation.
Okay.
Very nice.
It's a honor for us.
Yeah.
What's his name? Okay. Good.
Okay, so so you can see that connection between bank credit tightening and unemployment, because that then is the question of whether recession is going to be hard or soft. Yeah. And so
Also author of over 6-7 books,
great. No?
including on scams.
Yeah.
frauds.
So yeah, so the question for us is, at least in the US, is how well the unemployment will be managed through these measures like lowering interest rates, giving boost to the housing industry, credit tightening, and that's going on right now. But as you said, there's a survey by the Economic Research Bureau, which is the Economic Research Bureau is the sort of standard that most companies use in their own economic data. Yeah, and not the World Bank and IMF and all that, because they rely on the US economic research data as a basis for understanding unemployment. And then right now, the general consensus is that it will be a soft recession, not a hard recession, but there will be a recession. But the next question is when, and that all depends on the whether the fund, as I think that you saw in Mr. Kannan's presentation, that next year from March onwards, it is predicted that the Fed is going to reduce interest rates, which will help to boost the housing market, which will help to reduce in recession, likelihood of recession, as I spoke. But the question is,
September 22, it was at 1.2%. You said one, no?
Yeah. So right now the question is, if you see the stock market is already excited about the whole thing, that the Fed is going to reduce inflation. So the capital markets, if you see in the US, are anything. So within the capital markets, you can see some sectors are just okay. But
Jayesh has a valid point.
Yeah.
The differential also in mortgages between US and India has narrowed down. Their mortgages have become very high.
Yeah, because exactly. Yeah. So I would say that at this moment, because I'm also a personal investor, and I also talk to investment managers. So on the equity market, there is over enthusiasm, and I think the equity markets are overbought. You can see that from the RSI index also, relative strength index also, that.
Oh, that's great. You have come on really.
Yeah. So
momentum and making.
Yeah. So that aspect is, yeah. And I personally, I do it for my own personal investments as well. I'm using this data, what I'm seeing here, to manage my own personal wealth, which I have to do, because you have to be invested. First of all, you can't be non-invested. So my general rule is be invested. Yeah, and just go with the flow, and then I sell covered options, call covered call options.
Oh, wonderful.
Yeah, because that's for a person who's busy on a day-to-day work, I can't trade on a regular basis.
Complex derivatives.
No, but selling call option is which is out of the money. Yeah, in a market like this, I would say is a reasonable strategy. Yeah, because that gives you the yield.
So
Selling call options, covered call means you should have the stocks of that company. Yeah, so that's a good. Like I personally use that strategy and it's worked well. It's not worked all the time.
why out of money?
Safety.
No, but out of money. Yeah.
Yeah.
You want to hold the stock also.
I have to hold the stock. I have to hold.
I'll put it very simply. If you have bought it as stock at least 100 rupees.
Correct.
And you want to sell it at 130 rupees.
Yeah.
Assuming you want to, then write a call of 130 rupees.
Yeah.
So if it is 130 rupees, you already, so
Yeah,
you will
yeah.
be able to sell it 130
Yeah.
rupees. That's your target.
Yeah.
And if it doesn't reach 130, whatever premium you have
Yeah. Yeah.
paid. that
So I'm
goes in
using
your
my-
pocket. It's like a rental income.
Yeah.
Yeah.
You rent your house or rent your stock, right?
Yes, complete the slides.
Okay. So I'm just giving you a little I'm using this as a key. Yes, your stock is not going to boom. See, one thing is you have to be invested in stocks. You know, stocks will rise if there's no geopolitical issue like dollar reserve currency status is gone because some other currency, Indian rupee has come because India signed a deal with Russia. People got very excited, but it'll take time for the US dollar status to go away. So till that doesn't happen, dollar will remain the world currency. Yeah. And till that happens, follow the US stock market. I think there's a correlation between US stock market and other world, markets, not direct, but indirect, but at least, directionally where the world is going on capital market side. And there'll be, as I said, it's not a question of if it's going to happen. The recession is going to happen. So expectation is that if the government is not able to manage this, right now it's a very critical point because housing market is still not in a good position. The index is still high right now. So it has to come down. That has not come down yet. So we have to wait till the index comes down, then we are comfortable. Right now we are still a little bit in the shaky waters. And so that's my takeaway from a economic understanding of where we are and how I play myself with that information. Then the next step is, I just want to go quickly. How much time do I have?
2 minutes.
Okay.
You can come back.
S&P going in the highest level.
Yeah.
S&P is at the highest level.
Yeah. So that's I think there's over optimism in the because the whole market is expecting now the other diagram, right? The inflation has come down. Yeah. And the Fed rate is higher. So Fed has to decrease their yeah. So yeah, but how much will they decrease? And you said 6 times next to yeah, that's almost the expectation that Mr. Kannan had mentioned also, and that's pretty right. But only question is how much. So now that expectation is already baked into current pricing of the stocks, and people are happy. Yeah, but will it last at this level for next year? I don't think so because that's already baked in. Yeah. So now can only maybe hearing some negative information. So this is a good time to sell call options. I think personally that way. And then again you have these other risks, cyber risks. Yeah. See, buying I don't, because I don't buy. We had the discussion. Okay, buying I lose money because you can't never time the market, right?
Any the influence provider.
Yeah.
Not influence buyer.
Yeah, because if you buy, yeah.
You are writing the
That's how wealth is made. Warren Buffett made more money through insurance than through Coca-Cola.
Yeah.
The next one, then you be ready.
Yeah.
There's a lot more.
Okay, so this is all about impact of what I said because people are interested in the economics sort of things, but I use that information to sit down with my people who are designing products for the insurance companies, and that's a whole new chapter. There's a whole new chapter of how insurance companies can enhance their yield on assets. And the area that actually I specialize is in the second last asset allocation and new product design. That is all the new investment product design for insurance companies. So I can just give you a very short description of what I actually do for work. This is all how what I actually do is we create certain new products in the investment which never exists because we are $65 billion company, right? We are very specialized people in various segments like infrastructure and everything else. So things that are generally not very liquid, we may create liquidity. And we want insurance company to buy that product from us. Why? Because insurance companies have long-term liabilities. And generally, you never see 30, 40-year-old products in the market that insurance company can buy, because they have to buy products and then roll them over. Because you can never match the liability of the insurance company, 20, 30, 40-year liability for life insurance companies, because you don't have assets that can match that duration. So the insurance companies have to buy products for like 15 years or 10 years, because if you buy too long products, then it's not then the bid ask price is very different. So you have to have liquid assets on your balance sheet. And it's not easy for insurance companies. That's the problem. The problem for insurance companies is to
asset liability mismatch.
both, not both, but it's a big problem for insurance companies, because and then you have got two options. You have to roll it over, your assets, reinvest it again in the same, but then you don't know the market condition at that time, or you buy derivatives, which is also money, expense, to hedge certain risks. So in either case, you have a lot of uncertainty. Even with derivatives, there's a cost, it's not free, right? So that eats away your yield. So for the insurance company, the issue is you don't have assets in the market to really to manage, to be able to accommodate the amount of insurance liabilities that's on the balance sheet. So it's a big, so asset managers, therefore, where I get into picture is, okay, so now let's say some asset classes are illiquid. For example, solar loans. I'm just giving one example. All the solar loans, loan given for solar, you have a certain mortgage and then you take solar loans, but it's a very illiquid type of market because they are loans. So what you do is securitization. So there's some few companies who will just approach all these second loans. There'll be some middleman doing that job, and then they'll come to us, or we will go to them and say, okay, now we'll securitize that solar loan into various tranches. Tranche A, tranche B, tranche C. Tranche A is the most liquid. So although it is solar loans, they'll issue from a loan, it can convert into a bond. So that's how it works. And the bond is rated. So they'll get S&P or somebody else, there are some other companies who will rate those bonds. Once it gets rated, then insurance company can buy it because regulatory risk. And then that's how the process works. And that's where we get into picture, because there's a legal aspect to it, and there's a financial aspect to it, rating issues. And then we can sell it to our own company, or we can ask other insurance companies to buy that product, because
conflict of interest नहीं
No.
आपके केस में आप बोलते हो आपके होल्ड कंपनी एसेट मैनेजमेंट
Yeah.
आपकी स्टेप डाउन सब्सिडरी इंश्योरेंस कंपनी
100% you are right. So there's something called arm's length. So the regulators are very keen, and the tax also very keen on the arm's length nature of the transaction. So they look into that very carefully. Auditors are there. We have PwC as auditors. So it is to the extent, and US is a very regulated mindset. So we almost get an approval depending on the situation with PwC even beforehand. That is it okay? So we get a sort of an opinion from them. We don't want to get surprised, because the last thing you want is that we have done this, because every asset has capital charge, right? So we have said, and if suddenly because capital charge for a bond is around 7%. That means for $100 bond, capital requirement is $7. And if you don't qualify the bond, and then becomes an equity, then it's 30%.
Oh.
And if it was 30%, you get fired, because you should have told that before to the board of directors, because they made the decision on that it was 7%. So we have to be sure that it gets a bond treatment. Yeah.
So something
30% capital charge. Yeah. So anyway, so I'm just keeping it short. That's my.
We can have now some thoughts from Paresh.
Yeah. So this is
After
yeah.
Paresh, we have some
Yeah.
thoughts on the US markets.
Yeah. So this is my prepared.
Yeah, please, you want to sit here?
Yeah, no, the guy said here. No,
You are,
I said there.
Wonderful. It can
Your
be a
snack is
full
there.
session.
your snack.
And more from you. When from there also.
Yeah, please take the.
I said there.
Continue sitting there.
You can sit here. Good, Karan.
Robin, you are in, a few thoughts from you?
Yeah, he's there.
Directly from the website, because loading the website.
Robin, you are there? A couple of minutes,
Yes,
some
sir.
thoughts from you
No,
before
no,
Paresh starts.
you people continue. You people continue.
It's very, we can't hear you clearly, meaning the volume is very low.
I'm saying you people continue. Great discussions. Please continue.
Okay, he's asking us to continue. Manoj.
Questions can be sent on chat also, they would all be answered.
So this is the first time I'm appearing to share my thoughts on the current stock market. And I'll just give you a background. I've been an institutional broker for the last 35 years. So, and I've retired since last 2 years, and I do my own trading and investment now. Till 30 years, I was, in the purview of compliance. Now it doesn't apply to me. In spite of that, the disclosure is these are all my personal thought process, which I use in my current investments. And for the next year, I'll just the market depends mainly on 3 points: macro, liquidity, and risk, which I will discuss later. But to summarize my thought process, उसको mute नहीं कर सकते. I can't mute him.
So you make it only later. He will. It's presentation.
So there is no disturbance coming in.
You have a presentation?
No, I don't have a presentation.
Oh,
I'm just talking, looking at my notes.
Yeah, good.
So as I mentioned to you, the main 3 points which we can discuss is macro, which is affecting the market, then the liquidity part and risk. This would cover 90% of anybody's thought process if he's an investor in the market. And so I've divided my view on this market for the coming year. It's like from January, the market will be very highly volatile with a bearish view. February and March would be bearish. April to August would be sideways market with a bullish view. And August to December, the bullishness will increase, and by December it should be super bullish. So let's discuss the macro. What has contributed to the current rise in the market? Current market is very euphoric. It's more of political stability. The reforms which have been conducted in the last 10 years, which I feel are irreversible. And there are more reforms to come, which would be the tailwind for the market. And the connectivity infra, the ESG effect, the UPI effect, the AI effect, and all that has yet to come into the stock market. So the current run in the market is mainly because of this points. Of course, the government's balance sheet has also improved a bit. And the coming to the next part would be liquidity. What is supporting the market, and why I don't see a major fall in the market is because liquidity is very high in the market in the hands of smaller investors and retail investors. That is being shown. Anecdotal evidence is the SIP part, systematic investment plan. The other part is there is no alternative to 90% of the Indian public other than the stock market to get a better rate of return than real estate or an FD or anything else, or even gold. So, and the third part is the new investors which are coming in, smaller salaried people, a small mom and shop pop people. They are pumping in their liquidity. And also, as I mentioned, the digital part of sitting at home and transacting, when there's no need of calling a broker, and all that is giving way to liquidity for a better rate of return. Now, the liquidity part we have to discuss in every quarter. This year, this quarter, there has been a withdrawal of a good amount of advance tax. Again, why I was telling you bearish view in March is because of huge profits have been booked, and there will be a lot of advance tax which is paid. Then we have an election round the corner around May, June. And the corporates will have to liquidate their money to fund the elections. That will see a lot of liquidity being sucked out. And so that is the liquidity part. And the risk to the market would be inflation, which currently is, cooling off a bit. Interest rates are also cooling out. The most major risk, as I was mentioning to Mr. Kannan, is that we are around 22 times to 23 times of the forward PE, which is a major risk. And somebody was mentioning about RSI. That is also very high now. But individual stocks will do well. But overall, the market can come off. There are a lot of people who have started, buying puts, especially for December and stuff like that. And they are all seasoned players, and there's no reason to doubt their impeccability. The other part for my,
They're
you
buying.
can't call it bearishness, but they're buying puts. And I'm not bearish on the market, but a lot of HNI investors, ultra HNI investors, they are all sitting on cash. The current euphoric thing is more to do with the, people trying to trade in and trade out very fast. Right? Most of the investors are scared, and everybody feels that the market will fall, but nobody knows the trigger which can bring the market down. Even I can't see any trigger other than some black swan event coming in, like it's mostly geopolitics or a pandemic. Currently, people are slowly thinking of COVID, raising its head, but it looks very difficult. But geopolitics, nobody can predict. But as you were mentioning, Ukraine and US and Russia, they're all running out of cash. So it's going to be range bound between, my personal feeling is the index would be range bound between 18,000 to 24,000 in 2024. And but we have had a very good run up. So this euphoria is unwarranted, but we can't stop it because new investors are coming in. And I would say more than 60% are well informed. They are not just buying on somebody's recommendation. They are trying to read a balance sheet properly, trying to understand. And some of the investors are such that they would invest only in an industry which they understand, probably like a renewable. They understand that, and therefore they invest only in that kind of stuff.
But China and Russia are big investors.
In India. So China was, China
Even
was.
now, even now.
So I don't know how they are able to come, because the startup premiums were there because of the Chinese money. So that has evaporated, if you have seen. So, and some of the startups you can't even exit. So Russian money is coming through Dubai and all that. That is well known. So that is why you are seeing all the smaller SMEs and all, getting a good premium valuation. And other thing is this GST coming in, and it's formalizing the informal economy. That is the reason. It's not a new addition to the actual economy. Like if you were 3 trillion crores, now you're saying 4 trillion. So I think most of it is more of the formalization of the, like UPI, even a Belpuriwala has to, file his return. So formalization is going to help. So I feel the market cannot crash, but it will slowly come down a bit. And that is the main factor would be liquidity. Geopolitics and everything is very unpredictable. We cannot do anything about it. But I normally we quote that even if you invest at current levels, 2-3 years down the line, you won't be standing to lose your capital in the stock market. So it's very safe to say if you continue doing your SIP and all that, you won't lose money.
Yeah. So I'm just trying to understand the US, because US, the Fed rate and the mortgage rate is very quick correlation. There's a very strong correlation, and you can see the impact immediately. So there's a measure that the Fed takes, and the impact you see on the economy is pretty soon. And is it correct to say that when the RBI changes rate, the impact of that on the commercial banks, US Bank, we have been there, how fast is it? And how accurate, I would say, how the connection between the change of the reserve rate, bank's rates versus the commercial rates for mortgages?
So I think Kannan would be a much better person, since you've asked me, I'll give my 2 bits and I think Kannan can add more.
This is something right from the time of Governor Rajan, there was a talk about what we call transmission of rates.
Yeah, transmission, yeah.
That, when RBI changes, how quickly and how effectively the rates transmission over
Transmission, yeah.
the whole of the economy. And we've seen that the correlation was far lower earlier. But because of some very strong arm measures taken by the Reserve Bank to drive home the transmission at a much more faster and effective pace, now there is a better correlation. However, there are some parts of the economy which are more closely and clearly aligned to the changes made by Reserve Bank, and therefore they happen quicker and more realistically. But there's still some parts of the economy which are not so well correlated. So I don't want to go too much into it in the interest of time, but it isn't a yes, no answer. There are many sort of gray areas and nuances to the whole thing. Kannan, over to you.
And just to add, in India, typically, unorganized sector is much larger. Still, they also, if you look at it, there are 40%. So that is where the issue comes.
The
You
issue of
can't correlate that with
the Reserve Bank, US. From a change of Reserve Bank and the impact on the
effect.
the trickling down effect to the
Basically, this reserve and repo rate, we call it.
The repo rate, yeah. Repo rate, yeah.
Repo is more applicable for banks.
Banks,
Institutions only.
Yeah.
And this is not linked with the ultimate borrowers rate.
Yeah.
Banks have their own MCLR.
Yeah.
It's called like marginal lending rate. So because of that only, banks sometimes have their capital liquidity, because they are not borrowing from the RBI. So that's why they keep the rate change. So it's a lag of 3 months, you can say. In
Okay.
3 months time, it start reflecting to the consumer side.
Right.
It's like a reduction, it's like a enhancement. Enhancement should also not happen immediately. But 3 months time, it passes.
So that's a big difference because for us, the US Fed is a very
There is the rate.
then you see that it's a tool. The tool is
Sorry, since you mentioned about the tools, something I wanted to talk during the previous presentation, your presentation. Unlike US, where the whole thing is driven by the monetary policy.
Yeah.
India, there is a very strong fiscal policy impact which controls the economy, which is you're not finding in most other countries. India is unique in that way. There's a tremendous fiscal policy impact which comes from the government, not from the Fed, not from the Reserve Bank. That it helps in multiple ways, whether it is supply side, the administrative prices we have to control prices, whether it is the fuel, whether it is the food grain, in many other areas, or distribution to free grain. There are a lot of fiscal measures taken by the government which play a role in managing the economy, including Reserve Bank's what we call managed currency rate. Now, the US doesn't like it. They think we are playing with the currency. But I think RBI is doing a fantastic job in keeping the rate within a band of like 83, 84, 82, 84, which is a good thing. When you have a stable currency, people feel more confident about the country. So these things which are sort of unique to India or different from India, which you don't have in many other countries. So you have to see that also, how things are happening in India. Sorry, continue.
We talk about banking, NBFCs play a major role. Banks have net interest margin of 3 to 4%. NBFC is a microfinance. They have net interest margin between 10 to 15, 16%. So when RBI does 25 basis points and all, it doesn't have much effect on this.
But that's why when
And just to add, RBI has to restrict how much NBFCs can charge.
Yeah, 10% more than the cost.
No, now that
It's at 26.
No, now this is removed. This is not there.
Cap is removed. No, cap is.
It was there for MFI only. not
MFI.
for others. So that also removed last year.
So now it has been removed. There are some MFI which has a net interest margin reported of 16,000.
Yeah.
but fiscal measure become more political also, right?
Yeah,
So
and
that's
possibly because, as you said, because fiscal measures are so important, everybody looks at the budget presentation every year to take decision on the investment and stock market.
Yeah, but it's also political also, right? That's another dimension to it. Yeah. Okay, sorry.
No, I'm done, so.
But budget impact is nowadays, what I have seen is reduce something.
Yeah.
Because all that reserves and all that policy
Throughout
are
the year.
coming outside the.
Yeah, throughout the year.
Throughout the year.
So,
Previously, yes, I agree, if you talk about before 5 years, 10 years, the budget, everything will come in budget. No more.
Yeah, may not.
Now it's more dynamic.
But still the fiscal policy becomes so important for people to take.
Yeah, but they are not announcing anything in the budget actually.
Yeah, it's a more stable and a statement of fact on the, like.
Yeah, correct. It's like a, giving them information, that's all. They are not taking any measures in the.
You know, they, in the budget, they have started giving forward-looking statements also, so they say for 5 years, 10 years, and that, you know, which may not have impact in the current fiscal.
Now technical charts, no?
I don't.
You're coming?
So tell me, what is the next, I mean, you want to.
Can you put on the chart for US Treasury first?
US
Yes, right.
Treasury trade, yeah, sure, why not?
Yes, right.
Yeah, yeah.
What
no,
does it
no, it will come.
Any, what is the view on how much percentage comes or how many bits? Fed may reduce in the, because
Okay.
they announced three.
Fantastic.
Now
Okay.
it is not
Fantastic.
5.3.
Acha, first, which chart is
That's
this?
true, but they announced three cut will be there in the next year, 2024.
Could be even 6.
They are saying now 6.
Yeah, they were saying, yeah, from March onwards,
6 is what the market is hoping.
market is
But
hoping.
the Fed is not, Fed has said
The-
maybe 3, but the market expects 6, you know.
Market is expecting,
But
Fed, every Fed meeting, if you see every Fed meeting,
Abhi current kya?
Jerome Powell will say, I need data.
5.5.
I need data, yeah.
I need data.
5.5.
So, because Fed can't make anything without data. So, market will say, Fed will say data.
Which chart is this?
This is yield, that means US Treasury yield.
Yes, your thoughts, half a minute and your thoughts.
Okay.
We got 5 minutes to go, we are wrapping.
So,
US Treasury chart.
yeah, so I'll tell you,
Your thoughts, Jayesh, Naresh?
see, this is 10-year Treasury yield chart, not the bond price, the reverse opposite.
Yeah.
Now, I think something similar related question I forwarded to you also. Basically, my interpretation. See, first of all, I tell you one anomaly which is being observed. Generally, the US globally, the bond price and equity move in reverse direction. But in recent past, last maybe 45 days or 2 months. In US, bond and equity both are rising. S&P 500 rising, bond is rising, which is very unique. It rarely happens, but it is happening in US, not in India. Whether
First time it's happening.
first time, or maybe first time in a long time. I don't know whether it happened in 60s or 70s. I don't know, but
Talking about bond prices, not yields.
so yield is going down, bond prices is going up. So
I don't see a dichotomy here at all.
Hmm.
If the interest and expectation,
Yeah.
if they go down, both will go up, no?
so
Equity and
basically,
bond have to both go
so
up.
basically it is happening
So
some
I
kind of
think that-
front running, meaning because of Fed's repeated refusal to raise the interest rate, and I think in our last meeting, they kind of gave indication that it is going to fall. So it is way ahead that positioning happened. See, this is a weekly chart.
Yeah, thanks, doctor. Acha, now we have 2 minutes. One great idea from you, Rangesh.
My great idea.
One great idea, then one great idea from Ani.
All right, so we sit.
No, anything, it can be anything.
No, I could have said anything because I had treated multiple industries in my career. But since he introduced me as a real estate